cash is not king if you're trying to build real wealth. Growing up, we were taught to save our money, but I want to make it clear saving and investing are two different things. Yes, we need some cash on hand. We need some level of safety when it comes to our money, but we have to think about the big picture. $10,000 sitting in a bank account with a 3% APY is going to earn you about $300 per year. And that may sound good. We then have to factor in inflation, which is also about 3%, making your profits basically zero over time because your money is losing value. Everything keeps getting more expensive. The gas, the grocery, our insurance, everything. But at the same time, the stock market, the tech sector, my growth investments are growing way faster. So I'm encouraging you to find the balance, having cash on hand for those emergencies, for stability, to make sure you're staying out of debt, but having as much of your cash invested, building and growing so that you're not falling behind financially. So I'm definitely not saying that savings is bad. I want it all for us, and it's part of the strategy to create a wealth machine for yourself. Everyone needs an emergency fund. I do not ever want to be in credit card debt again. I want to be ready to face whatever problems come up, no matter what the amount. I know there are larger expenses that come up, like repairs to your house or car. We need stability. Life happens. And that's why I make sure to maximize having any cash sitting where it's actually earning the best interest possible. Here are a few of those places. This is protection. This is not building wealth. My traditional bank account pays basically nothing. Bank of America, 0.01%, while my high yield savings accounts are at around 3%. And my cash over in the MooMoo Investing app is at 3.35%. So here's the interest earned over 1 year on a $5, $10, and $15,000 balance. Take a look for yourself. I'll run through the base $10K, about $310 at Discover, $335 on the MooMoo Investing app, and just $1 at Bank of America. So these APYs, they were around 5%, but 3% is still a drastic difference than what you're getting at a Chase, Bank of America, Wells Fargo, something like that. Now, let's look at some historical rates of returns on investments like VTI, which is the Vanguard Total Stock Market ETF. These are annualized rates of returns. So they are much stronger long-time returns than any savings account could ever have. Over the last 3 years, about 22%, 5 years, 13%, and 10 years, 15%. I've been building and holding this investment right here for about 3.5 years, and I'm already up 46%. My $8,900 contribution is a little over $13,000 value. And then when it comes to growth-focused investments like VGT, which is the Vanguard Information Technology ETF, those rates of return are even higher. 3 years, 33%, 5 years, 21%, 10 years, 25% on average. Here's a look at SPMO, which is Invesco's Momentum ETF. Now, this one has a higher expense ratio than the other two we just took a look at, but even stronger returns. So the difference becomes massive over time. This is how you can be on track to really build wealth. A savings account preserves your money. Investing builds real wealth. And I have accounts for different reasons. I definitely prioritize my retirement accounts, which I do over at Fidelity, but I have taxable accounts also that I can tap into for early retirement or for whatever I need. And so building money there is going to make a huge difference over 5, 10, 15 years, as opposed to just trying to hold on to cash. So my high yield savings account, my brokerage account, low growth on my cash, but I'll take it compared to the rates I'll get at my local bank or credit union. My foundational ETFs, like a VTI, faster growth, and then those more aggressive ETFs, even stronger growth over time. Now, once you realize investing is required for growth, the biggest challenge is staying focused, keeping your emotions out of it. A lot of people panic during market dips because they don't have a system. They're not in tune with the news. what's going on with the stock market. Why are we having these huge fluctuations? It's easier when it comes to your 401k or 403b because it's probably just coming out of your paycheck, but it is disappointing to see your portfolio dropping by tens of thousands potentially. And you can see that I've been through over the last couple of years. This portfolio holds primarily FXAIX, which tracks the S&P 500. 500 of the largest companies in the US, a basket of stocks, an index that will recover after those tough times. So for me, level one is that safety, money in the high yield savings account for emergencies, your bills, just general peace of mind. And of course, so that nothing lingers on your credit card. Finding that right balance for you might take some work. 3 to 6 months of expenses could be a good fit, but take into account, have you lost jobs? How long does it usually take you to find your next role? How many people do you have depending on your income? And then figure out the right amount of cash to have on hand to suit your family's needs. Level two is the foundation, holding on to those investment accounts, whether for retirement or in my taxable accounts that are building and growing on track for when I need to tap into them. And right now, I'm focused on growth when it comes to my portfolios, a bit more aggressive, like AI, semiconductors, those growth tech funds. SMH is one that I've recently incorporated, which is the VanEck Semiconductor ETF, which has even higher returns than the funds that we've already looked at today. Over the last 3 years, on average, about 64%. 5 years, 38%, and 10 years, 37%. A newer addition. Currently, I'm up 16.29% and have about 4 shares. These are parts of my portfolio that can accelerate my growth over time. These are the type of investments that I want my cash sitting in now. I definitely have stability with my investments that are low cost and diversified, like my FXAIX. But now I'm focused on boosting my returns, trying to make sure that all of my finances are a priority. Saving, available credit, being in tune and on top of what is my credit score, continuing to invest, not tapping into my investments when emergencies happen. All these things play a part in my strategy, but your investments are what can truly change your financial outlook. You need savings, but you also need investments. Balance that stability, but make sure your money is growing for you. Have a financial plan that's not gonna allow inflation to quietly eat up all of your gains. Remember, you don't need thousands to get started with investing. Small amounts add up over time. Just be consistent. And you don't need to get started by doing anything fancy. The S&P 500, a total U.S. stock market fund, is a place that any investor can start. So here's my question. Are you using cash as a tool? Does every dollar have a job? Are you like me and making sure that your money is making more money? Share your thoughts in the comments. And if you enjoyed this video, don't forget to like, subscribe, hit that notification bell. Hype this. Take a second to check out my referral links and some more of my videos that will help you to stay on track to keep on building. Thanks for watching. Okay, bye.